Ben with Vessel Futures Trading. We're back in the market. Today we're going to talk a bit about the S&P again, and we're going to jump maybe to the gold contract just for a quick recap what we did last week. On the S&P, we can see over here S&P made a huge drop from last week till today. It was basically a major drop from the supply area, the major supply area, to the major demand area. As always, we can see that when it reaches supply and major demand, it's going to try to achieve to the other side. And we see how S&P is doing very clearly, and on the way creates for us minus supply areas. When the graph hits it, it possibly may flip. So we started with the day interval last week and went down to the 4 hours interval to mark the pools and try to seize opportunities within the day if you're trading within the day. Of course, if you swing trading, you can see a very clear pattern of how basically the S&P, the price hits it. Basically, we can see right here the sellers get into the picture right here at this point, dropping all the way to the major demand. Buyers started getting into the picture, and now we can obviously see that they basically made the supply minus supply area that created over here, and this candle that represents still the previous day. We see a struggle candle that maybe possibly get us to a second check to the demand, right? And they possibly create this pattern, either gonna drop from here to here and basically create the second test. And if it does gonna create this, we're gonna take a long position from here all the way up over here, possibly go all the way over here. If you're a swing trader, basically created a pattern of second check and a long position towards the major supply. Now, if we're not certain what to do at this point, because we see there's a struggle candle, there's no confirmation candle that's gonna let us get into a short position, we might be not trading in on a swing. We're gonna try to seize opportunity within the day. But going to the 4 hours chart, we can see obviously what's going on over here. We can see that already the price hits it 1-2 times and already start to climb up. We're not certain enough if we're changing our methodology to a long, basically the climb position. Why is that? Because we don't see a new high breaking. Let's say over here, this is the previous high, and we don't see over here that the price crossed it. We still are in a short position. As long as this price not crossing this line over here, basically as long as it doesn't happen, we're not changing our methodology, we're still looking to short position it. But if we're not certain it, we don't have to trade it as a swing trader. We have to seize the opportunity within the day. We know that when it's reaching a major demand area, it's going to try to achieve the whole move towards upwards. But as long as we don't see it, we're not changing the methodology. It means that we still can short position it. What we want to see, we're going to go to the 15 minutes interval and we see how the price behave. We see all those new highs is breaking on the 15 minutes areas. We can see that we have still a bit need to go all the way over here. We don't want to go against the trend, so as long as it's rising up over here in the 15 minutes, we're not going to short it. But when it get to the supply minus supply area, we do want to short it. So if you're still not certain what to do, either short it or long it, you either not trading this contract, or basically waiting for the pattern to be more clear and waiting for the price to hit the mid pool as well over here to see if it's gonna break. What we want to see, in order for us to get the long position, we want to see the price basically crossing up the pool, getting out, landing back on the pool area for a second check, and then go up with the long position from here. This is possible. This is the first possibility. Second possibility is, second scenario is basically we understand that we are in a minus supply area, and when a supply area, we're going to short position it. Where we're going to short position it, basically the price will hit it over here and go down for a second check, as we said in the we mentioned it in the 4 hours interval, and going up and back again towards the major supply area. So those are our possibilities right now. If you're not certain how to do and what to do, you don't have to trade this contract. We just I want to emphasize what happened last week, and what's the possibility? Either you're swing trading it or you are trading within the day. Of course, within the day we have more opportunities to seize it, where we can see clearly that we can either long it from here, long it from the pool, waiting for it to land on the pool area, or just long it from the last minor demand we've been created over here. But this is for last week's cover. I want to talk today a bit about the gold contract. I think it's a bit easier to trade. Obviously it's a very clear uptrend. We can see how the prices met the demand area over here and how we met the supply area over here. You can see a very clear pattern that basically every time the price hits those supplies and demand is being flipped and reversed. 1, 2 times, 1 second time, and this is the third time we're reaching the demand, breaching the supply area and going up. So it's very easy to trade this contract right now. What we want to see, obviously we're going to go with the trend. We want to take a long position. With the 4-hour graph, I'm going to make basically the demand area right here, and I would want the price to meet this pool once more to get to a long position. So if I traded the 4-hour interval, I'm just going to wait for the command to work. I'm going to reach a long position command over here. I'm basically waiting for the price to hit, go back to make this drop, and I will make a long position from here. This is scenario number 1. Now if I want to trade within the day, I'm going to go to the 15 minutes interval, and I'm going to see where the possible entry is